Robin Ching is here with us on set. Their chief China economist, of course, to underscore what your baseline is. Let's start there. What is your base case scenario?
Well, tariff risks are here to stay. We have a gradual but steadily increase of tariff from today's 10% on everything to 15% by mid of this year, 20%, 26% by end of this year, and probably to 36% by end of 2026. So that's gradual and a steady increase of tariff.
Now, Robin, I want to drill down into something that you highlighted in your report, and it's not something we've talked about a lot, but it impacts a lot of shipments from China to the United States, and that's that duty-free de minimis exemption for packages of $800 or less. Now, everyone says, why do I care about this $800 or less? Well, there's been about 1 billion different parcels going from China to the United States that Customs and Treasury can't simply account for, and they want to close that loophole. What kind of impact is that going to have on top of the tariffs on Chinese e-commerce and overall shipments to the United States of products?
Stephen, that's a good point. Many investors probably overlooked that. In fact, some people thought that Trump may have been going easy on China. But on day one, he asked the administration to review 3 things. One of that is this small-scale exports exemption of $800. A lot of e-commerce platforms are using that to do cross-border exports to the United States. If that part, after April 1st, with the new memo from U.S. administration, they charge some tariff, is going to have some disruption to e-commerce platform.
It's also considered a national security threat, because they feel that some products that they can't secure or can't open up and don't necessarily know what's coming in, whether it's fentanyl precursors or other illicit goods. So that's a closing of that loophole is something the Biden administration looked at as well.
Well, I think it's clear that the pathway for de-escalation on trade tariffs will be very, very narrow. You mentioned one of the concerns, national security. Take other things like export control. The high-tech exports from U.S. to China, that's off the table. So some investors are asking, is there any chance of a grand bargaining deal, like China-U.S. going back to phase 1 deal? Because that's one of these things Trump administration is reviewing now.
Right.
And it's expected to be ready by April. But if you look at phase 1 deal, it was too ambitious. China committed to purchase an extra $200 billion from the U.S. from 2020 to 2021, and it fell short. They reached about 60%. Can they re-deliver that today? 6 years after phase 1 deal, a lot of things changed. The national security concern, the export control, and high-tech export from U.S. to China, that's completely off the table. So I think the bar will be very high for them to reach some kind of de-escalation deal.
Right. And supply chains have also rejigged, because if there was a pandemic, by the way, in between the phase 1 deal and right now. Robin Ching will be rejoining us later on to talk us through the implications and more, of course, from this fantastic report out of Morgan Stanley. Futures and your pre-markets are looking like this. We are on track for a weekly gain here in Hong Kong. 5 minutes away at the opening bell. This is the China Show. Right, welcome back. The approach to the open is we're pointing higher, and we are set to open higher. We're set for a weekly gain in Hong Kong. We could actually eke out one onshore. Globally, equities have done extremely well this week on the back of this rally in the U.S. We are close to a record high on the global gauge. The open is next. This is Bloomberg. Good morning. Welcome back. You're watching the China Show. You're just in time as we have a couple of seconds ahead of the open. And some breaking news right now. We were largely expecting these next few days or so. But since it falls on the weekend, it did come out today. The 1-year medium-term lending facility is out, unchanged on the rate. Is a net withdrawal of just under 800 billion renminbi. So effectively, the headline is they've conducted 200 billion of 1-year MLF, and you do the MAT net, what you have is effectively a withdrawal of 795 billion. as far as that is concerned. Okay, the approach to the open today, and it's worth pointing out, of course, it's Friday, and it's almost a universe ago that we had this live briefing yesterday. I almost forgot about that. And certainly when you look at markets, they've more or less forgotten about that. Massive pop at the open yesterday.
But it petered out.
It petered out into the close, as you point out. And as you can see, the momentum has certainly continued to the downside right now. About 0.25%. We do have two bond auctions today. I think we have a 2-year and we have a 5-year bond auction today. About 230 billion renminbi is being auctioned out, so just watch for that very closely. The open in Hong Kong is looking like this. We are doing slightly better. If I could just cheat my screens here. Yeah, there we go. 0.5% to the upside. We are on track for a second week of gains here in Hong Kong. Okay, we have a lot of stocks to get through, in fact, so please bear with me as I just sort of rummage through my notes here. Okay, CK Infrastructure down 0.4 to 1%. The story here is that the company is said to be mulling weighing the sale of one of its assets in the UK, Rail, rather. Okay, flip the boards, please. Next one to watch. Oh, this is a big story. This is a big story. New World Development is up in the equity market. Some of your bonds are trading right now, and the fact that we're at 40 cents tells you everything you need to know about the sentiment around this company right now. The company's out with a statement. Sales actually in mainland China topping their estimates in the 6-month window to December. They're also talking about guidance and the revenue pipeline for Hong Kong, and they're looking to hasten that. Go ahead, Steve.
We need to break that down on whether that is an aberration, because they're saying that they're getting already 70% of their annual target in just the first 6 months, China's sales numbers. Probably not by value, maybe by units, but we'll have to see whether, because that would be very good in a very troubled Chinese market if you're getting already 70% of your perhaps already lowered target just in the 6 months.
Yeah, that's a key context there. What are they doing right? I think it's certainly a question.
Or is it a fire sale?
Or we don't know. In fact, you know what? For our Bloomberg clients, we do have actually a deep dive coming up on this. In fact, it's already on the terminal for you. We've dissected what it means for the company and also the exposure of Hong Kong banks to the story, and more on that in the next hour of the show. Tianqi Lithium, profit warning out of the company. It's halting some of its expansion plans, and it's out with some guidance on its impairment, too.
Chief China economist at Morgan Stanley. So we talked a lot about tariffs, and we can maybe expand that conversation to how it relates to the policy response in China. What is needed? There's been some stabilization, there's been some policy, but there's been promise fatigue as well. What is needed to get this policy working for the Chinese economy? Or does it actually, in your report, you say authorities might think they've done enough to stabilize the economy that they won't get the big bang stimulus? What's your assessment?
It's a complex picture, but let's break it down to 3 things: tariff, deflation, and the undershooting policy stimulus. On tariff, our base case is a gradual but steady increase of U.S. tariff. And that's already happening, affecting Chinese economy. Why? Because every single firm is trying to front-load their shipment to the U.S. as much as possible, as fast as possible. That contributed to this fourth quarter GDP, which came at a beat.
And exports, perhaps an aberration in December. They were up more than expected,
exactly.
10%.
So out of this 5.4% official GDP number in fourth quarter, half of that, 2.6 percentage point, was contributed by net exports. That's the contribution from front-loading of exports due to tariff risks. So you can see once tariff is here, say, from second quarter onwards, then you will see payback from that front-loading. That's why our base case for the Chinese growth will be nominal GDP will be probably hovering around below 4% from second quarter onwards, once that payback from front-loading is there. So it's still a deflation problem.
Yeah.
And the policy reaction you mentioned, I would say they are trying. There are some small steps have been taking place, and in the National People's Congress, they will announce more measures. But it's not enough to reflate the economy.
Will they undershoot at NPC, though?
We are talking about 2 trillion yuan. 2 trillion yuan expansion of this augmented fiscal deficit. So that's smaller than 1.5% of GDP. So it's a very modest package. And a lot of it is still about investment. That's the problem of China's deflation. Too much investment, too much capacity. And the boost on the consumption side is still insufficient. That's why I don't think this MPC stimulus package will be enough to decisively reflate its economy.
That's the old cocktail, Dave.
I mean, it really is. And I think this goes into my next question. And someone asked me this recently, and it was actually a very good question. If China is hitting its growth target, why does it need all this stimulus?
Well, the target was hit partially because of the front loading of exports. Right. Back in fourth quarter, half of that 5.4% was contributed by net exports. That's not sustainable with the payback. Once tariff will be here, it's going to affect the exports, supply chain, and some corporate confidence. By the way, all this investment-driven growth, like manufacturing capex, is also creating problem for headline pricing indicators because there are too much capacity. So you can see firms cannot sell their product at a better pricing. That's why nominal GDP matters more than real GDP. Real GDP is volume, but because GDP deflated is in persistent deflation, now nominal is roughly around 4% or even weaker. Firms cannot sell their services or product at a better pricing. That's a problem.
I was going to bring up the GDP deflator because it really does show you the impact of deflation on this economy. I mean, a lot of people like to make that simple comparison to Japan's lost decades. But is this a harbinger to a similar kind of situation in China where they cannot stimulate their way out of the deflationary spiral?
Well, I think one thing they can learn from Japan is shift the policy from a supply-centric mentality to consumption. Japan gradually is reviving now, but that's after so many years, and they learned, and they tried, they keep trying. China today is in year 4, the 4th year of this housing downfall. I think if they learned, maybe it won't take them like a decade to find the right dope of policy. But this is 2025, year 4. I think they are still in the year of trying. Maybe it's not enough. It's not working yet. They will try again until the social dynamics, the feedback from public sentiment and the perception of social instability will force them to react more decisively.
Are you seeing any green shoots in the housing market?
I mean, transaction volume in Tier 1 cities stabilized a bit, but if you look at nationwide, because of the inventory overhang in most cities, nationwide investment and sales is going to decline by 10% this year by our estimates. So it's still a very weak housing market. That housing adjustment hangover is still affecting Chinese economy. It's still a drag to economic growth.
Can the Lunar New Year holiday that's coming up be a good springboard for consumption? Or is it going to be like last year, where it was a blip upwards and then it petered out?
Well, they are definitely doing a little bit more on consumer stimulus. This cash for clunkers subsidy has been extended. Now people can buy phones, tablets, not just the cars or TVs. So that helped some sectors. But if you look at the size, maybe 300 billion, 400 billion RMB. And China today is a 135 trillion economy. So that package is just too small.
Yeah. I want to round up the conversation with tariffs. We started with that. That seems to be the big issue here. And certainly the uncertainty over the timing and the magnitude is almost worse than the future outcome. And I'm wondering, does China have the capacity to do something to avoid tariffs? Are there concessions they can be made inside trade or outside trade, for example? Is there a scenario with which they can avoid?
Well, that's the number one question everybody has been asking. Looks like on day one of the U.S. new administration, they didn't emphasize too much on the Chinese tariff. So the market was talking about maybe they can go back to have a trade deal or a grand bargaining deal. But we took a deeper dive on the phase 1 deal. It was very ambitious, but it fell short.
But then the pandemic happened.
Yes, there's a lot of factors, disruption from COVID, but it was just too ambitious. The targets were too high. An extra $200 billion purchase in 2 years. If you look at it today, that's even harder for China to do that because supply chain changed over the last 6 years. Some ways it's a good thing, but it's both a curse and a blessing. Chinese companies becoming more and more competitive. That means out of these 97 sectors, China gained more market share, more trade surplus in 57 sectors over the last 6 years. And they don't need to import that from US. Yeah, there are still some high-tech things US can export, but that's off the table due to national security concern.
Yeah.
So the difficulty of reaching some de-escalation just based on how much they can do on trade side is very, very
Vice
hard.
Premier saying they're going to buy more. They can buy more, but we'll see. Right, Robin Xing, Chief China Economist at Morgan Stanley. Always good to have you here in the studio.